Good morning, Brendan Rendo with the Homes Orlando team here with our Orlando weekly housing market update. Fortunately, Joe won't be able to join us this morning. He's taking care of a client, which is always good. Well, after a very tumultuous week last week, been kind of quiet the past couple days. And what we're seeing is kind of a leveling out of the market, but there's still a lot of underlying concerns that are popping up. Because what we're seeing, and one of the big things is recently the Fed came out and said they were going to start unwinding their balance sheet. And they did. Starting in roughly about July, they started selling off their assets. They had close to $9 billion in assets on the Federal Reserve balance sheet. And what they did is they started selling off a number of those assets. And we went from a peak of about 8.9 trillion, excuse me, wish it was billion, down to 8.3. So they had unloaded about $600 billion worth of assets. But then came the banking problem. We saw SVB, Swiss Bank, and several others start to have liquidity problems. And something that needs to be of concern to everyone is within the past 2 weeks, literally about 14 days from March 8th until the 22nd, the Fed added back nearly everything they had sold off. They had increased their balance sheet $400 billion. And that liquidity was basically to help save other banks from failing. They set up a separate line. Don't know where they got the power for that, but they invented one that is basically allowing banks who are holding these treasury bills, say a 1% or 2% interest rate from when the Fed dropped rates so low, to actually get a 100% value of those bonds, even though if you sold them on the open market, they'd probably only be worth about 50 to 60%. And why would you say maybe only 50, 60%? Because if you've got a bond at 2% and I can now get 4% or 4.5% on the rate, it's basically going to cut the value in half. I have to basically double the return to get the same as if I bought a brand new bond. So what they're doing in that case as well is they're basically overinflating the value of assets. And this is where we have continually gotten into trouble. And we kind of taken a shot of medicine, hoping that it's going to cure the cancer, but it's just kind of masking a lot of the underlying problems of the economy. And it's something we're going to have to watch. Are they going to be able to adjust this and start to turn it back around? Which I don't know if they can, because you've got all these banks out there with all these assets. And you've also got something that finally people started talking about last week is the commercial backed mortgage securities, which we've got more maturing in the next, 3 to 4 years than at any time in history. And a lot of these commercial mortgage backed securities were also written in that 2% range. So you've got occupancy rates sitting at roughly 60 to 70% of pre-pandemic levels. So there's no rental income coming in to cover the debt of these buildings. So it's a mess. It's a mess. It's going to take a long time to unwind it all. And there's going to be pain from it. There's going to be a lot of pain from it. And people just have to make yourselves aware. I mean, one of the largest commercial holders, actually the largest commercial real estate holder in the world, BlackRock, actually has halted withdrawals from their investors on their funds. and or limited them. Let me correct that, because what's happening is if they had so many people coming, just like SVB, just like other banks, so many people coming to get their capital out because of their worries that they didn't have the liquid assets, which in commercial situations, commercial property situations, the asset is the property. So if you've got, you know, so much liquidity from the rents, and then people all of a sudden want to take out 20% of a fund, you've got to sell the assets. Well, the problem is you may have bought the asset at $1 billion, and right now you can only sell the asset for 600 million. You've got a huge loss. So they actually had to pull back as well and limit the withdrawals of their funds. And what this has done is, interesting enough, on Friday last week, when all this was really kind of hitting the fan, is we saw a huge flight to safety. And where do you go for safety? Well, there's really two places you're going to go for safety. The first one is gold. And for the first time in several years, I think it may have reached it a couple of years ago, not exactly sure the date, gold actually broke above 2000. It actually hit a peak of, I believe, $220 on Friday and then pulled back. And that's a ceiling we haven't seen broken. It's one of those that you watch just to see where money's heading. So you've seen a huge flight to safety. And even though it did pull back, you're looking at, this morning sitting right there on that 2000 precipice for gold, which I think if we break it again, you can see gold take a much bigger jump in the future. The other thing was with our US Treasury bonds. You see, over the past couple of days, we really kind of leveled out. But here, again, back on Friday, when the market, everyone was panicking, where do you fly to? You fly to Treasury. Why? Because fortunately for us, US government has never defaulted yet on US Treasuries. So when you've got more money coming into the market, you're pushing those yields down, and the price of the bonds actually go up. You see, it's kind of bounced back a little bit, and we're sitting about 3.56, and we've kind of hit a nice level spot. So but the interesting thing was, on Friday, we actually broke below the 200-day average on the treasuries, which I thought, well, this could do one or two things. It either pushes way back up, or we can actually finally see that we've broken through and we're going to see interest rates fall. But it didn't go that way. And I think a lot of that, quite honestly, is because the moves of the Fed and taking back nearly $400 billion back onto their balance sheet. I think if they hadn't done that, I think you would have seen a continued flight to safety and a continued push of the yields down. So there's a lot, even though the market feels calm this week, a little bit calmer, that maybe we've stemmed off a total bank run. There's still a lot of underlying problems in the system. And right now, I know when we looked at the Fed Watch on last Thursday, when we looked at this was actually higher. People saying that the Fed wasn't going to increase rates. We're actually sitting at no change of roughly 46, but we basically did a flip-flop. This was sitting about 52. This was sitting about 46. So right now, a little over half the people in the market are betting at the next Fed meeting we're going to have another increase, which I'm kind of torn. I don't know which way I think they're going to go. I think the next couple of weeks, if we see continued kind of calm, kind of a nice window of trading, I think the Fed will probably do the quarter point. But I think if we get one more bank that runs into a situation like we had over the past couple of weeks, I think at that point they've got to just say no. We're going to hold steady. We're just going to hold steady at this point. And I think if they do that, they're probably just going to hold steady through the year, um, and let as much wash out as they possibly can. So those are the underlying things that are going on in the market, and it's something you got to keep an eye on all the time, just so you know. So just so we have a good idea of how things are trending, because it does affect interest rates. It does affect unemployment. Um, I also need to make a correction. I apologize about this. Last week, got a little overzealous. Said that Amazon was laying off 90,000. I apologize. It was actually 9,000. So please, I do apologize about that mistake. So that's a quick recap of what we're seeing in the overall market that's affecting interest rates pretty much on a daily basis. So when we break into what's going on here locally, it was actually a good week for the market overall. Across the United States, we actually saw a slight increase in pending sales, and a lot of times this happens again because of interest rates. We saw that interest rates take kind of a steady push down. And the bank situations help people actually save a little bit, because if you were closing mid month or early in the month, the rates took a quarter point. People were able to possibly relock their loans, get the save themselves $200 or $300 a month on a payment, which of course equates to a ton of money over time. But what we've seen here in Orlando is we really have seen a steadiness start with the number of home sales. We're really sitting around that 400 or a little bit higher than 400 homes per week. Our inventory is starting to really level off, which is nice, but I would love to see it go up. I think if we could see even another 500 or 600 homes hit the market in the next month, which we're really starting to come in to the spring selling season as we go into April and May. April, about a month before the end of school. School here in Florida ends, mid-May. People are going to start getting ready. They're going to start looking at the selling of their homes. So hopefully we're going to start to see that go up, and that may help actually push down prices a little bit with more people being available. And if we can see rates continue to stay steady, or even pull back to that 6% level, I think if we pull back to that 6% level, we could see sales numbers actually take a little bit of a spike up. Our condos staying very steady again, number of sales. And inventory for the first time in several weeks actually went up a little bit. It's only 17 units, but hey, 17 is better than nothing. Then one of the big numbers we would look at every week is the original list to sales price and the final list to sales price. This really stayed steady compared to last week, sitting right about that 94.5% and 97% with the final sales price to the final list price. And you'll see here, and really probably the biggest number of homes in the Orlando area, between the 300 and the 400, you got about, that's really where most of the homes are selling. But you're seeing this where the percentage is dropping a little bit. We're actually 95.5% in the 400 to 500 price range, and actually 98% over from the final sales price to the final list price. So that's tightened quite a bit since even December, January. The sellers have gained back about 3 to 4% of what they were looking at. And that could be a couple different things. One is sellers and agents working together to better price the homes, price them correctly. People back in December were still feeling like, hey, my friend just sold down the street, back in July, back in August, and they got this much. And it was tough to sit there and go through them and say, well, we've seen a decrease since then. And you actually had to go through numbers with them. But that's nice to see for the seller's end that, hey, that's tightening up. They're not having to give away as much. And that comes back a lot to our inventory. And here you see we're holding above for the past several weeks. We're holding above that midline, that median line for sales in Orlando, and we actually popped up a little bit. So last week we were 444. This in March has stayed very consistent, and this is a good level. I'd love to see this, but at the same time, to make up for the ones that are being sold, we've got to get more houses on the market for people. I did an open house for a new listing in Altamont Springs, a nice townhome, and had 20 people on Sunday through the house. That's just showing me again that the inventory limitation is there, that you've got that many people coming through an open house, that there's just, there's still limited inventory for them. We actually saw, pull up a little bit further, we actually saw our days on market go back up a little bit, but we're holding steady right around that 60-day mark, which historically is just a little bit over average. Not much, but a little over average. But again, that's because people are paying a higher interest rate, so they're going to take their time and they're going to make sure they find the right house. People just don't seem, with my buyers and people coming in looking at houses, they just don't seem as in a hurry, as stressed to make a decision right at that moment, because they are spending a good, I believe right now the average is about 36%, which is one of the highest in history of total income being spent on a home. So they're going to take their time. They're going to make sure, again, that they've got the house right. And this is nice to see. It has really leveled off over the past couple of weeks. We're only about a 50 house difference or since the March 5th report. Now we need to get it turned back up. We need to get this average back up, to that 4,400. We need to get it up to that median line, because then I think we're going to have a much more balanced market. Going to give buyers a lot more opportunities than they've had over the past couple of years, actually. With the condos are basically sitting the same. They're a little less original list to final list. 95.5 roughly, and 97.5. And here you see up at the higher end, again, sellers only having to give about 2% off the final list price. Then our weekly sales, again, we're in the spring season, so you would expect them to turn up a little bit, and we have. And I'd love to see that continue. And then again, with the inventory for condos, this truly has leveled off. We're sitting below the average, only 100 or so, 150, but it's still below the average. But it has leveled off, and hopefully this will continue to push up a little bit, which again will help buyers overall in the market. In our days on market, interesting enough, this one took a huge jump week to week. So some of the older units that have been on the market for a while finally got sold off. So overall, the market so far has been quiet this week. It's actually been really nice, because we're not having to look at the headlines every day and trying to figure out where all this craziness is going. The Fed stepping in has helped really quiet it down, but it came into a fairly big price, about $400 billion back onto their asset, and making some moves that, honestly, I I don't think they should have done. But they're also trying to save up. They were trying to stop a total meltdown, and for now they have. But have they postponed an inevitable situation? Well, we'll never know. We'll just gonna have to sit and wait and see. But right now, market overall is in good condition. There's homes out there. Rates is stabilized for everybody. So, if you're interested, give us a call. We'd love to talk to you, help you find the right home. Uh, Thank you for your time today. Enjoyed it. Please join us every week here on Thursdays at 10 o'clock. If you're on YouTube, please push the thumbs up, help push this out. If you're watching on Facebook, please hit the like button. I enjoy doing these every week and look forward to seeing you again next week. Take care. Bye-bye.